Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 9.5 of Unit 9, Technical Indicators. In this lesson, we're going to cover Bollinger Bands, a powerful tool for measuring volatility and identifying trading opportunities. By the end of this video, you'll understand how to use Bollinger Bands to improve your trading decisions. Let's get into it. So what are Bollinger Bands? Simply put, they are three lines plotted on a chart. A middle line, which is a 20-period simple moving average, and two outer lines, which are the upper and lower bands. These bands are two standard deviations away from the middle line, which means they're calculated based on the volatility of the market. Think of it like a highway with a middle lane and two outer lanes. The middle lane represents the average price, while the outer lanes represent the range of prices that are within two standard deviations of the average. Now, let's talk about how Bollinger Bands measure volatility. When a market is volatile, the bands widen, indicating that prices are moving rapidly. This is like a stormy sea, where the waves are high and the tide is rough. On the other hand, when the market is quiet, the bands squeeze, indicating that prices are moving slowly. This is like a calm sea, where the waves are low and the tide is smooth. A Bollinger Band squeeze occurs when the bands narrow significantly, indicating that a big move is coming soon. This is like a coiled spring, where the energy is building up and ready to be released. When the bands squeeze, it's like a warning sign that the market is about to make a significant move. As a trader, you want to be prepared for this move by adjusting your trading strategy accordingly. A breakout signal occurs when the price breaks out of a squeeze with force, indicating that the market is making a significant move. This is like a dam breaking, where the water rushes out and creates a new path. As a trader, you want to enter the market in the direction of the breakout, as this can be a profitable trade. However, it's essential to remember that breakouts can be false, so it's crucial to use other technical and fundamental analysis tools to confirm the trade. Mean reversion is a concept that states that prices tend to return to their average value over time. In the context of Bollinger Bands, mean reversion occurs when the price touches the upper or lower band and then returns to the middle line. This is like a rubber band, where the price stretches away from the average and then snaps back. As a trader, you can use mean reversion to your advantage by buying or selling when the price is at an extreme level, with the expectation that it will return to the average. Bollinger Bands can also be used to identify overbought and oversold conditions. When the price is at or outside the upper band, it's considered overbought, indicating that the market is due for a correction. On the other hand, when the price is at or outside the lower band, it's considered oversold, indicating that the market is due for a rally. This is like a thermometer, where the temperature is too high or too low, and the market needs to adjust to a more normal level. When the price is in a strong trend, it can walk along the upper or lower band, indicating that the trend is likely to continue. This is like a train on a track, where the price is following a clear path and is unlikely to deviate from it. As a trader, you want to be on the right side of the trend, as this can be a profitable trade. However, it's essential to remember that trends can reverse, so it's crucial to use other technical and fundamental analysis tools to confirm a trade. Bollinger Bands are best used for measuring volatility and identifying consolidation before breakouts. By using Bollinger Bands, you can identify periods of low volatility, which can indicate that a big move is coming soon. This is like a calm before the storm, where the market is building up energy before making a significant move. As a trader, you want to be prepared for this move by adjusting your trading strategy accordingly. In a volatile market, Bollinger Bands can help you identify the range of prices that are likely to occur. By using Bollinger Bands, you can see the width of the bands, which can indicate the level of volatility in the market. This is like a weather forecast, where the bands are indicating the level of storminess in the market. As a trader, you want to be prepared for the storms by adjusting your trading strategy to account for the increased volatility. That is everything for Lesson 9.5, Bollinger Bands. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.